I sneezed and lost sight of the skylark. Yay you! The market is an easy game to play. It is just that we are hell-bent upon making it so complicated. That is what makes it so difficult for us to win. A glance at the do's and nits of trading in any market reveals some easily understood and seemingly simple rules to follow. We have all seen them 100 times. They are the rules that all traders, both professional and non-professional, are supposed to follow. Remember, I said supposed to follow. The rules have been time and money proven. The most important and basic rules of trading and investing are as follows. 1. Buy low, sell high. 2. Let profits run, cut losses quickly. 3. Add to a winning position, not a loser. 4. Go with the trend. These rules look simple and are certainly easy to understand. So, how come so many of us kill ourselves in the market? What makes it so difficult to follow these guidelines? More than likely we've repeatedly broken each of these rules and will probably continue to do so, despite acknowledging that we'll end up losers if these simple guidelines are not followed. How come? The answer to this question contains a secret for our future success in the market. The problem lies not within the rules, but within ourselves as we apply these rules to our investments and trading decisions. Yes, the problem is internal, and until we learn to change our perception about what makes the market tick, we will continue to punish ourselves and remain on the losing side of the ledger. This book attempts to offer insight into those teachings that have shaped our responses to the market as very clear directions. Through a retraining of our conditioning and thought processes, we can at last begin to see what the market is saying and not what we want it to say. We will be able to hear the market as signals and respond accordingly. The process of Zen, if it can safely be called a process, reveals that the market gives clear directions as to what course of action to take. The mental discipline of Zen will help cut through our own fog of self-deception and finally allow us to see clearly and feel the true course of the market. Then we can and will act accordingly. Zen discipline helps us to dissolve those actions and perceptions that have kept us from the winner's circle. Let us go back to those rules and see what happens to us in spite of knowing the rules. Instead of buying low, most of us wind up selling low and buying high. The causes are many and the excuses are laughable. Uncle Joe gave us a hot tip that turned out to be an iceberg. Everybody else was buying midget widget, so we jumped in, too. The stock had a good balance sheet. How could it not go up? I circumflex all of the wrong reasons, but still very common excuses for getting involved in the market. We hold on to losing positions and start hoping that the market will turn around and reward us for being a little early in calling the correct direction of a market. That is not the way it works. More than likely we hold on to losers until we cannot stand the pressure or have to meet a margin call. Usually we act at the bottom if we are long or at the top if we are short. We're supposed to get out of losers quickly. What kept us from doing this? What makes it so difficult to take our losses? This book answers that question and supplies a simple but difficult solution. Worse than buying high and selling low is adding to a position that is not already profitable. For example, we bought ABC Bioengineering Co. at 22 a share, and it is now selling for 18. Our broker calls and says that the stock is still on their firm's buy list and thinks that we should buy more. The broker tells us to average down our position. We agree and buy another 100 shares. We all know that it is easier to compound our mistakes than to correct them, and that is exactly what happened with that purchase of another 100 shares at a lower price. A losing position was added to, despite our determination not to add to losers. So, why do we add to losers and punish ourselves and our pocketbooks with this most grievous of investment errors? Why is it easier to add to a mistake than to correct one? The winning positions are usually cashed in too early. We get a few points of profit and congratulate ourselves for being so smart. Then we watch as a stock or commodity continues to climb, and climb. Why didn't we buy more as the position proved itself a winner? We know the rules, but something inside of us wins over. What is it? If we can identify this mysterious force, are we willing to contain its power over us? We have all bought stocks because we thought they were cheap, ones that once sold for 80 and are now selling for 36. Wow, I can now buy at 436. It is cheap. We can get twice as much, almost like 2 for the price of 1. Sounds crazy, but some of us do it all the time. I cannot think of a dumber reason to make an investment decision. The rules say go with the trend. In this case, the trend is certainly down. Yet we fool ourselves into thinking that we are getting bargains. We're fighting the trend. We can clearly see that the direction is down, yet many of us think nothing of averaging a loser. We know the major rules. What makes us want to break them and place our capital at greater risk? Every one of the rules that has been tested and proven over time continues to be broken by professional and non-professional traders alike. What can we do to ensure that these rules are followed to the letter? We cannot have a policeman stand over us to make sure we are trading by the rules. So, what can we do? Enough of the questions. On with the solutions that have worked for those willing to work hard. Notice that word work.I circumflex the tis, what it takes to correct our errors. The first step is to recognize the error of our ways and be determined to do something about it. The result will be a permanent change in our behavior as it applies to our attempts to make money in the market. These rules are for stocks, bonds, options or futures, or whatever market you trade. It is all the same. The problem is that we bring to the market a set of notions plus a system of logic that just doesn't work. We must first rid ourselves of these dangerous forms of self-deception before we hear the market's call. Ridding ourselves of ourselves is the most difficult problem we face when attempting to make money in whatever market we're involved. In reality, the market puts us in a contest with ourselves. Until we let go of the false ideas of what makes the market tick and simply respond as the market unfolds, we will continue to be punished. The discipline that dissolves the veil of self-deception between you and the market can be attained in many ways. I have found that the spiritual path offered by Zen philosophy and meditation works for me. Through this discipline, we can work at reducing our ego's interference and kiss the old, irrelevant logical systems goodbye. Rest assured that our egos will fight us every inch of the way. The battle is long and hard, but it is worth every ounce of sweat. When this is accomplished, we can begin to live and focus in the present moment. The promise of this approach is that once the nature of the beast within is recognized for what it is and we understand the dimensions of its powerful grip on everything we do, we will be able to grasp the flow of the market and be on our way to becoming very successful. First, we must recognize the weapons we are using to sink our financial ship in the murky waters of the market. Once we see that we are our own worst enemy, we will move on to the process of extinguishing such interference from our dealings with the market. We must first recognize the symptoms before undertaking the cure. Chapter 2, Getting Rid of Big E. Big E for error? No, not exactly, but close. Big E is our enemy, the enemy within all of us. Big E is our ego. Let us look at how the ego operates, how acute that is, how it operates us in the market. We read or hear something and immediately form an opinion, extrapolating the consequences of the information that we have just consumed. If we are wise, we will see whether the market confirms our opinion. More than likely we'll just jump in and take our position no matter what the market is saying. Then we wait for the market to prove us right. Sometimes it agrees with us immediately, and our position becomes an instant winner. When it doesn't, the trouble begins. Ego starts to tighten its grip over our ability to do the right thing. The right thing is to get rid of our losers immediately. The ego will produce the most fantastic reasons for holding on to that money-draining position, be it in stocks, bonds, options, or futures. Ego will fight us all the way and prevent us from realizing quickly that it is better to swallow our pride and do the right thing. Take the loss before it becomes expensive. We know the rule that says take those losses quickly and move on. Ego gets between us and the rules in order to preserve its self-esteem. Really, ego has a life of its own within all of us. Its hold is more powerful than a plutonium bomb. When I was a broker with Bear, Stearns & Co., some of my clients would say that they didn't have a loss until they took it. They would hang on until the market proved that they were right. How ridiculous and how very expensive it was for some of them. Again, ego imposes its will over what we know to be the correct action. Objectivity tells us we are wrong. Ego tells us to hang on. When we have a winner, ego manifests itself by coaxing us into taking our profits quickly. Why didn't it get us out of our losses quickly? The ego will get us out of our winners fast because it needs the immediate gratification of being right. It likes being right. It will deny being wrong. Fire our ego? Hard to do. Being aware of our ego's tight grip is a start. You can reduce ego's hold in your investment practices through very hard work. Playing the market is the hardest way to make an easy living. Egos wanna die. Just being aware of the power of this force gets you started in the right direction. Egoless people have nothing to protect. They just do whatever the market tells them to do. They don't tell the market what to do or what it is going to do. They have no ego directing them, so it is very easy to flow with the market's directions. What is difficult is ridding ourselves of our ego. It takes a lot of training, years and years of it for some of us. It is like school. When you pay attention to what the teacher says, you get good grades. In this case the market is our teacher, and it pays to listen. The Zen approach is to realize the many dangers of an ego-led trading and investment style and determine not to be misled by our ego. Easier said than done, but it is not impossible. People have been known to meditate for years before being able to unshackle themselves from the tight grip of their ego. Some fortunate ones have a natural ability to act in an egoless fashion. They are easily identified, for they are the big winners in the market. Other parts of their lives are affected positively as well. For us to become egoless, and therefore more likely to succeed where we have failed previously, requires a new way of viewing the market. Egoless sight is seeing things for what they are and not for what our ego would like them to be. No distortions change what is in front of our eyes. We act upon what we see, not what we want to see. There is simply no hoping, no praying, and no weird rationalizing. The truth revealed without egoist interference is our goal. What Zen shows us is that we are truly one with the market. The market isn't here and we are there. We don't have to beat the market. The market will give us what we earn. Just open up those egoless eyes and listen to what the market wants to tell us, not what we want to tell the market. What I am saying is that the market makes all the decisions. Our only decision is to listen, feel, and respond to the market's siren. Always and without exception. Remember, the market never lies. It is only we who lie to ourselves. Chapter 3, Saying Goodbye to Aristotle. Most of us come to the market with the notion that if certain events happen, the market should react in this or that way. The market will go up or down because of this event. Let us call this Aristotelian logic, and let us promptly recognize that Aristotle belongs in universities and not in markets. Examine certain major events in the world and their effect on the markets. It is the summer of 1982, and Mexico has announced that it cannot make payments on the $100 billion that it owes. A default of that magnitude should have quaked the market in a big way. What really happened was the beginning of the biggest bull market in history. The Dow was in the 700 seconds. 10 years later, the averages have nearly quadrupled. Figure that one out, Aristotle. Each and every day the savings and loan disaster gets larger. It is going to cost the government much more than $500 billion to shore up that mess. Each day the figure gets larger, and the market yawns as though it is a non-event. Perhaps the market knows that you and I are going to wind up paying for it. Where is the $500 billion going to come from, anyway? Why hasn't the market reacted to this news? Didn't we read in Economics 101 that such a huge dent in the taxpayer's pocketbook is bearish for the market? The market is telling us not to worry. It is saying, forget what we were taught in school. It doesn't fit the scheme of things here. None of that schoolbook logic applies here. I circumflex. The Japanese stock market tumbled nearly 30% in the first quarter of 1990. Oh, bearish for world markets, I circumflex is what the logicians said. They were right for only one world market, the Japanese stock market. Nearly every other world market went higher and did not fall. Those who said there would be a delayed reaction were only covering for their ego as failed predictions. We are concerned about what is happening here and now, not what might or might not occur in the future. In the business of the market, the here and now is all that there is. The future is now, the past is forgotten, and we focus on the present moment. Logic only gets in the way. Balance sheets and PE ratios are only one small part of the picture. How well you play the inner game is what determines whether you will be successful making money in the markets. We must realize that the market defies logic. It has a logic all its own, and it won't tell us in advance what its reaction to events will be. We can watch for clues and then react. Basically, the best we can hope for is quick reaction time to the market as signals. We must first wait and then follow, not interpret. When we interpret correctly, we claim omniscience. What we get is a false sense of empowerment. When we are wrong, we forget about our miscalculations. How insidiously clever is the ego. The dartboard throwers have proven that they are much better than most money managers. The rush to indexing, a popular form of investing, is an admission that the managers cannot figure out the direction of the market either. Mega billions have been put into index funds. All these funds want to do is be average. They are willing to settle for being average, because their managers know that the market cannot be figured out. They know that if they try, they'll probably wind up below average. Indexing is a sure way to be safe and to get paid. They do neither better nor worse than the averages. If the market were logical, we'd all be winners. So let us give up applying a system of expected outcomes to that phenomenon that has eluded the best minds sifting through a multitude of data for their analyses. Even the carefully programmed computers cannot give reliable information. The brightest minds in the world cannot figure it out, so how can we expect to do it? Our old nemesis ego will tell us that it has and will provide enough of the ammunition to support its false conclusions. It is very difficult for the mind to just watch the market unfold. Our minds, egos, left hemispheres, must get into the act no matter how many times they have been proven to be painfully incapable of doing the job consistently. Just give up the idea that we can figure it out. Listen to the market shout a very clear and unmistakable direction to us. All we have to do is listen, feel, and follow the market as signals, and not hope the market follows our lead. Rest assured. It won't end. Chapter 4, Hanging Out in the Present. Who cares about what happened yesterday? The markets are like the dice in a crap game. They have no memory. Only we do. What happened in the past has no known effect upon the market. But our memories are strong. We would like to think that history matters. Then we can worry and speculate about the effects of yesterday's events upon today's market. The stock market crash of October 1987 signaled to many the end of the bull market. They looked back to the events following the crash of 1929 and clearly saw how the future would unfold. Wrong. Instead, the market steadily gained strength and continued on its merry way. Those who kept thinking about the past couldn't believe their eyes. If they thought that there were parallels between the crash of 1929 and the crash of 1987, and that the market would follow a similar pattern, they were badly punished. If they played the short side of the market, They were severely punished. Every moment is unique, and every market is very different. Predictions about the future based upon similarities to the past are worthless. Had we kept our eyes on the present moment instead of focusing on the past, waiting for the stock market to sink once again, we would have ridden the market back to the new highs that it saw in the first half of 1994. Those who said that they couldn't believe the market could recover from such a severe blow and go on to post new historical highs missed yet another great opportunity. Believe what you see, not what you think. If seeing is believing, then we have to learn to accept what we see. The historians rate over the dying embers of the Japanese stock market when it dropped more than 30% in early 1990. Many have noted that following past crashes in the Japanese markets, it has taken 5 to 6 years for prices to recover to the level of share prices prior to the crash. No one thought that the US stock market would recover and set new highs so quickly. What makes them think that the Japanese market couldn't do the same? Focus on the present moment, and you will not be fooled by any historical nonsense.